Today we will be discussing contribution margins and contribution margin income statements. A company's contribution margin is simply its sales minus its variable costs, and can be expressed either in total or on a per unit basis. For example, let's say that a company's sales of baseball caps are $10 per cap, and their variable costs are $6 per cap. If we subtract the $6 in variable cost per unit from the $10 in sales per unit, we get a contribution margin of $4 per baseball cap. If we also know that the company sells 10,000 baseball caps, we could multiply all of the per unit amounts by 10,000 to get totals. This would leave us with $40,000 in total contribution margin. All of this can be summarized on the first three lines of the contribution margin income statement. Sales minus variable cost equal contribution margin. Contribution margin is not the same as net income. There are still fixed costs that need to be subtracted. So if we assume that fixed costs are $25,000 in our example, we have $40,000 in contribution margin minus $25,000 in fixed costs gives us $15,000 in pre-tax income. We can also subtract the income taxes of, let's say, 40%, which equals 0.4 times 15,000, which would give us $6,000 in taxes. $15,000 in pre-tax income minus the $6,000 in income taxes equals $9,000 in net income. This is the format of the contribution margin income statement, which is very important to remember and worth committing to your memory. Remember that sales minus variable costs gives us the contribution margin. If we subtract the fixed cost, we get the pre-tax income. If we subtract the income taxes, then we get the net income. Let's focus for just a moment on what the contribution margin means. On a per unit basis, it's the number of dollars from every sale that contribute to covering fixed costs and ultimately making profits. I like to think of it this way. If 0 units were produced and sold, the company would suffer a loss equal to their fixed costs. Every unit that they sell decreases the loss by the amount of the contribution margin per unit and eventually creates profits. So in our example, with $25,000 of fixed costs with a $4 contribution margin per unit, the company starts at a loss of $25,000 before anything is produced. Selling one baseball cap decreases that loss to $24,996, and the second unit brings the loss down to $24,992. Note that these loss numbers are decreasing by $4 each. This will continue, which is what these three dots are representing, until eventually we will break even, meaning that the loss is $0. Any additional baseball caps sold after the break-even point are pure profit, again at $4 per unit, since that's the contribution margin per unit. The next logical question is, how do we go about finding the break-even point? Well, we actually have a formula for it. The break-even point in units is equal to the fixed costs divided by the contribution margin per unit. Plugging into the formula, we have $25,000 of fixed costs divided by the $4 contribution margin per unit, which equals 6,250 units that need to be sold to break even. We can update our table to reflect the break-even point. So now $0 in profit are made when 6,250 baseball caps are sold, $4 are made when 6,251 are sold, etc., etc. There are a few other important formulas that can be helpful to discuss relating to contribution margins, which I want to apply to our example. The first is the contribution margin ratio, which can be found by taking the contribution margin per unit and dividing by the selling price per unit. So that's 4 divided by 10 in our example, which is 0.4 or 40%. This means that 40 cents on each dollar of sales contributes to paying down fixed costs and generating profit. We can use this value to calculate the break-even point, not in units like we did a moment ago, but now in dollar sales. We can take the fixed costs and divide by the contribution margin ratio, which will tell us how much the company needs in dollar sales to break even. For our example, we have 25,000 divided by 0.4, which equals 62,500 of sales to break even. Another useful figure is what we call the margin of safety. This is the amount that sales can decline before the company will incur a loss, and can be expressed as either a percentage of sales or in absolute terms. To find the margin of safety expressed as a percent, we take the expected sales and subtract the break-even sales, and then divide by the expected sales. If we want the margin of safety in dollars, we just compute the numerator of this formula. For our example, we have $100,000 in total sales minus $62,500 in break-even sales divided by 100,000. The numerator is 37,500, which is how much sales can fall in dollar terms before a loss would be incurred. Dividing by 100,000 gives us 0.375 or 37.5%. This means that sales could fall by 37.5% before the company would have a loss. The final set of formulas we will consider relate to a target pre-tax income that a company may seek to earn either in dollar sales or in units. These formulas are identical to the break-even point formulas, except now you must add the pre-tax income to the numerator. Let's suppose this company wants to make $35,000 in pre-tax income. The dollar sales required would be equal to $25,000 in fixed cost plus the $35,000 pre-tax income divided by the contribution margin ratio of 40%. When you do the math, you should get $150,000 of sales required to reach the desired target pre-tax income of $35,000. For the unit sales, the formula is the same except now we divide by the contribution margin per unit of $4. This gives us 15,000 units to sell to reach the $35,000 target pre-tax income goal. If you want to calculate the unit or dollar sales for after-tax income rather than pre-tax income, we don't really have straightforward formulas for that. So instead, you must first calculate the pre-tax income and then use the appropriate formula relating to the pre-tax income. For example, if the company was to desire a $24,500 after-tax income and the income tax rate was 30%, you can convert to the pre-tax income by dividing the after-tax income by 100% minus the tax rate. So that's $24,500 divided by 100% minus 30%, or $24,500 divided by 70%. Using 0.7 as 70%, we get $35,000 as the pre-tax income associated with the $24,500 of after-tax income. Now I made this problem conveniently work out to $35,000 of pre-tax income, which is the amount we already used. You would then plug the $35,000 into the appropriate pre-tax formula to get the desired dollar sales or unit sales, which, as you see here, we've already done in the previous step. Alright, that's everything I wanted to discuss relating to contribution margins in this video.